The U.S. job market is facing challenges from Washington's policy uncertainty, elevated interest rate environment, and of course, the impact of AI disruption. Here to help us make sense of all of it is Mark Hamrick, Senior Economic Analyst and Washington Bureau Chief at Bankrate. Mark, grateful for your time. First, give us your diagnosis. How would you actually describe the state of the U.S. labor market as we kick off July 2025?
Good to be with you, JD. We've been treated to a lot of data. We're still awaiting some data as we speak. And let's, first of all, level set that the U.S. economy has been strong. It's been much more resilient than would have been expected given everything that's been thrown at it, even, I would say, to date. And that resilience persisted even when the Federal Reserve was pounding the brake, trying to rein in this historically high inflation. I go back, almost 2.5 years now, where our Bankrate survey of economists was suggesting that there was an outsized risk of recession, even as many Americans wrongly thought we were in a recession. But we didn't experience that recession. And we've been through some volatility in 2025 with respect to ongoing predictions. Our most recent Bankrate survey of economists puts the odds of recession in the U.S. over the next 12 months at roughly 1 in 3. So that's elevated, but not catastrophic. And so now in the world we live in as of this moment, we're trying to anticipate the ongoing and future effects of tariffs, as well as the disruptive nature of the Trump administration in general.
The Bankrate survey of economists you mentioned from a few years ago, which of those projections did not necessarily end up holding true? And how did things maybe shake out differently from what a lot of those survey respondents originally thought?
Well, I would probably just go right back to that recession risk. The risks are always difficult to quantify, and there's probably as bad a track record as anything in trying to predict recessions. Let's think about the previous two that were truly catastrophic. The great financial crisis, where we had a 10% unemployment rate in October 2009, and then of course, unless you're an epidemiologist, you didn't see the COVID crisis coming, and we had an unemployment rate nearing 15% in April 2020. And so, those were quite garden variety recessions, let's say, in the last 25 years, and one would pray that is more the experience next time around when that inevitable event occurs. I would say that was the most incorrect diagnosis, but assessing the risks and assessing, let's say, the inevitability are two different things. The risks were elevated, but it just simply didn't materialize.
You and I are having the conversation on a day where we heard pretty significant job layoff announcements from Microsoft, 9,000 employees, and they're certainly not alone, as a lot of big tech firms are trimming their workforce. Could be AI disruption, could be increased wages. There's many reasons as to why. What do you think the average American should most keep in mind when they do inevitably come across big, scary sounding headlines like that with regards to layoffs and pretty significant workforce disruption?
Yeah, it's a dynamic time, it's a volatile time, it's a disruptive time, it's a time of tremendous innovation. Not all innovation necessarily works to the exclusive benefit of all involved. We think about another historical example of the past, 30 plus years, consumers, but it had its downside, which to some degree I think has been responsible for the remarkable political divide in our country, where one way of looking at it is sort of the haves and the have-nots, or the division of wealth and income. So with respect to technology, it presents tremendous opportunity, but also there is tremendous risk, and companies are trying to adjust accordingly to right-size their workforces, not only in the sense of, let's say, the total number of employees at any given time, but also the composition of those workforces. So to your question, JD, what should we do? I think that the call to action is much the same as it would be during, let's say, less volatile times, and that is, first of all, let's make sure that our skill sets are optimal no matter what kind of work work we're doing, whether you're a car technician utilizing the newest tools of the trade, a radiologist who may see their work going forward change with AI sort of doing some of the initial processing. Or just say you're preparing to go into college and want to make sure that some of your skill sets are optimized for what we think may be out there in the future. So having the right skill sets, trying to upskill on an ongoing basis, and to activate our professional networks so that they are fine-tuned, not when there is a crisis, but so that they're essentially active at all times. I think LinkedIn's a great tool for that. It's a primary tool, for example, used by HR professionals, but there are in-person connections which are vitally important as well, and those connections are not worth less than they have been historically.
What is the impact of tariffs that we've seen so far on labor market disruption or expectations for what they could still do to impact the labor market, seeing as how there's sort of split opinion, at least on the pricing side of things? A lot of people still think we may still see that, even if it's just a one-time price increase shock, that doesn't work its way to the system until Q3 or Q4. But what does that look like for the state of jobs?
I think, first of all, I think you addressed it at the outset here, JD, and that is we're really trying to assess the impacts of both certainty and uncertainty. So the uncertainty is, well, who is ultimately affected by the tariffs? What are the tariffs levels with respect to the bilateral relationships with countries like the U.S. and China, the U.S., Japan, U.S., Mexico, Canada? It's quite obvious, I think, at this point that those are going to be, dare we say, works in progress. And so it's very difficult to make confident predictions in that environment. The confident part, we know, is, there's a tool chest, a toolbox, so to speak, a workflow that sort of has come to define the Trump administration. And I don't think those things are going to change for the foreseeable future. And so these are things that we should sort of, much the same as the pilot in the airplane, basically advising, yeah, we're turning off the seatbelt sign, but you should keep your seatbelt fastened. I think keep the seatbelt fastened in the current situation as well. How it breaks down, I don't think we've seen a significant impact in terms of job cuts. Jobless claims in terms of new applications still historically low, and we have to reference also the ongoing growth of the workforce in recent years. So 250,000 new jobless claims has less impact than it would have had just a few years ago. Continuing claims obviously have risen to among the highest levels we've seen since the pandemic. And then with the ADP data, that's concerning. It doesn't necessarily always correlate well to what we get in the official government data. I think in terms of behavior, JD, I think employers are cautious. At the same time, they learned a tough lesson in 2020 when they let go of a lot of workers, and then all of a sudden it was, breakneck, put the car in forward again after being braking or going in reverse, and then having to bring people back on board. They don't want to be in that position. They want to make sure that they have the right team on an ongoing basis, and some of that involves retention until the point comes, if it comes, where they absolutely have to downsize their organization.
Yeah, we did see that big swing and miss to the downside, a negative print for ADP. To your point, not always a direct correlation between that ADP private payroll print and what we get from the government, but we actually get that on Thursday of this week due to the shortened holiday trading week. We have to leave it there. Very grateful for your time and context and much needed perspective. Mark Hamrick, Senior Economic Analyst and Washington Bureau Chief at Bankrate. Mark, thanks a lot.
Good to be with you. Thanks for having me.